aren't ready to sell until you are quality of earnings, financial statement ready, or Q of E for short. So, in conversations with owners looking to sell, I get asked a lot, what does Q of E financial statement ready really mean? Well, basically it means this. The value of your business is fundamentally based on your operating cash flow stream, commonly referred to as normalized EBITDA. You've probably heard of this before. This is a proxy for operating cash flow. Normalized just means the adjusted EBITDA that would transfer to a buyer in the event of a sale. A Q of E tests the viability of your normalized EBITDA for a buyer. It's an independent, objective report that provides a level of confidence toward the negotiated sales price. If your business's financial records are not Q of E ready, then the value of your company is vulnerable to be negotiated down by the buyer. Essentially, you won't sell for top dollar. At Visibility, we establish a robust backing for Q of E ready financials that a seller can confidently use to negotiate their intended sales price. A lot of lower middle market, smaller companies are running on profitability reports based on a modified cash basis. Such reports are not sufficiently supportable in a Q of E or even a basic financial due diligence review. So you might be wondering how we would fortify your financial records to be Q of E due diligence ready. Well, at a high level, here's what to expect. First, we align your financial records to a true GAAP accrual basis and build a clean monthly trial balance. This helps to sophisticate your monthly EBITDA calculation. Then, we cash proof your revenue. We will convert your P&L to a cash basis and reconcile cash revenue to deposits in the bank statement. Seems simple, but it's a lot more complicated than people realize. We identify one-time or non-recurring items. We carve out any mistakenly coded non-revenue deposits. It happens more often than you think. If a transaction does not tie, we have a clear explanation. Buyers do not want surprises. They want clarity. Next, we run a month-over-month flux analysis on the P&L stream. We call out one-time expenses, related party transactions, management fees, rent, all of it. Not because they are wrong per se, but because they must be transparent. The time period lens under the focus that is being analyzed is basically 3 years, or a current trailing 12 months plus the prior 2 years before that, month by month. From there, we begin to build a supportable normalized EBITDA stream. Not inflated, not optimistic, defensible, which is the focus. We also prepare for net working capital negotiations. That target becomes a peg in the purchase agreement. If you do not understand it, you can unintentionally give away value at closing. Why does this matter? Because buyers do not buy revenue. They buy sustainable, defensible cash flow, and they do not pay top dollar for a black box. Typically, buyers are willing to pay on the higher end of valuation multiples when an independent CPA can report clean, clear proof of how your business is actually performing. When we do this work in advance, deals do not stall. EBITDA does not get retraded, and sellers do not leave money on the table. That is what being Q of E ready actually means.